So if you look at the fine print of, say, a commercial insurance contract, or honestly even just your monthly cell phone bill, you will see this hidden architecture of power mapped out right there on the page.
Oh, absolutely. It's hidden in plain sight.
Right. Because the person or the entity actually using the service isn't always the one pulling the strings.
No, not at all. There is a very rigid hierarchy of who holds legal authority versus who merely consumes the product.
And in the insurance world, misunderstanding this exact dynamic is it's actually the single biggest reason professionals fail their CPCU exams.
Yeah, it trips people up constantly.
So today, for you, our learner, we are taking a stack of CPCU study materials to master a concept that seems simple on the surface, but it dictates the entire flow of liability and capital across the industry.
It really does.
We're talking about the exact legal boundaries between the policyholder, the insured, and the beneficiary. This is the ultimate study companion for CPCU students, insurance professionals, and, just curious beginners.
Yeah, because the everyday intuition most of us rely on is that if you use something or if something protects you, you own it.
Right, like if you wear a raincoat, the raincoat is yours.
Exactly. But contract law, which is what governs all insurance, completely severs consumption from ownership.
Okay, let's unpack this. Because to navigate the CPCU exams, specifically the core exams like 530 for business law and 551 for commercial property, you have to completely override your natural intuition.
You really do. You have to apply strict legal precision. And the absolute baseline formula established in the material is this: the policyholder equals the policy owner, which equals the contract owner.
Which makes sense, but we need to define what it actually means to hold a policy, because it's not a passive title.
No, none at all.
It comes with a very specific, very exclusive set of contractual duties.
Right. The formal definition from the study companion identifies the policyholder as the person or legal entity that owns an insurance policy and holds the contractual rights and responsibilities under that agreement.
So they buy the insurance.
Yes. And they are legally obligated to pay the premium. Plus, if changes need to be made to the limits or coverages, they are the only entity authorized to execute those modifications.
Wow. Okay.
They hold the power of renewal and cancellation, too.
So the critical shift in thinking required here is recognizing that the policyholder owns the contract, but they don't automatically receive the benefits of the contract.
Exactly.
Nor are they necessarily the entity being insured against risk.
Right. And in the legal doctrine known as privity of contract, the agreement exists solely between the insurance carrier and the policyholder.
Solely between those two.
Yes. The insurer has absolutely no legal relationship with anyone else, even if those other people are the ones benefiting from the policy.
The source notes specifically highlight how this concept translates across languages, which I think illustrates the point perfectly for international students.
Oh, the Chinese terminology example.
Yeah, in Chinese terminology, the distinction is built directly into the vocabulary, preventing the kind of conflation we often see in English.
That's a great example.
The policyholder is referred to as the tubyuren, literally the person who applies for the insurance.
Right.
Or jiganan kibren, the policyholder.
Mm-hmm.
But the insured, however, is a completely different term. It's bei yaksinren, meaning the person who is covered or protected.
The language itself forces you to separate the buyer from the protected party. I love that.
It's so clear.
And when you look at contract law, that linguistic separation reflects a strict legal reality.
Let's bring in the cell phone plan analogy from the notes to kind of ground this.
Yeah, that's a perfect way to see the skeletal structure of this before we get into complex commercial liability.
Right, so the individual who signs the contract at the store and is legally bound to pay the monthly bill, that's the account owner. That is the policyholder.
Yep.
But there might be 4 other people in the family consuming the data every day, but they lack any contractual authority.
Exactly. If a teenager using one of the phones tries to authorize, a higher data limit, the carrier will just reject it.
Because that teenager lacks privity of contract.
Right. What's fascinating here is how the notes use the house analogy. Think of the policyholder as the homeowner.
Okay.
The insured is the person protected inside the house. And the beneficiary is the person who gets money if something happens to the house.
Oh, that's really clean. Ownership protection and receiving benefits are entirely separate roles.
Entirely separate.
So to spot these separate roles operating out in the real world of risk, we need to look at a 3-tiered architecture.
Let's do it.
The text walks through 3 specific scenarios to escalate the complexity, starting with just standard personal auto insurance.
Okay, classic example.
So Sarah purchases coverage for a family vehicle. Sarah is the policyholder because she executed the contract. She's also the named insured, meaning her name is explicitly listed on the declarations page for coverage. And obviously the insurance company is the insurer. But her husband, however, is listed simply as a covered driver.
Right, and the legal implications of that structure are actually severe.
How so?
Well, Sarah is the only one bound to pay the premium, but, more crucially, she possesses the unilateral right to alter the contract.
Wait, meaning she could just drop him from the policy?
She can call the carrier and remove her husband from the coverage entirely. And the husband has no contractual standing to prevent this.
Wow.
Yeah, the carrier will not even consult him because their legal relationship is exclusively with Sarah.
That is wild. And that separation becomes absolute when we move into commercial lines, particularly group insurance.
Oh, absolutely. A corporate entity purchases a health or life insurance plan for its workforce. The corporation is the policyholder.
Right.
The business entity negotiates the terms, funds the premiums, and manages the annual renewals. But the corporation itself obviously doesn't receive medical treatment.
Right. A building doesn't go to the doctor.
Exactly. The employees are the insured. The entity holds the contractual power while the individuals receive the tangible protection.
Let's escalate this to the life insurance structure outlined in the notes, because this introduces another layer of complexity.
Yeah, the life insurance example is great.
So John purchases a life insurance policy on his wife, and they list their daughter as the beneficiary.
Right.
But wait, let me push back on the fundamental logic of this setup.
Okay, go for it.
If John is the one writing the check every month, draining his own capital to pay the premium as the policyholder, doesn't it seem counterintuitive that he gets absolutely zero of the payout?
It does seem that way, yeah.
I mean, like, from a purely financial perspective, creating a contract where the person funding the agreement receives absolutely no direct financial benefit at the end seems like a flaw in the system. Why would the legal architecture support this?
Well, it functions this way because in contract law, control is its own form of currency.
Control is currency. Okay.
Yes. John requires what the industry calls an insurable interest to take out the policy, meaning he would suffer a genuine loss if something happened to his wife.
Right, right.
But his position as the policyholder grants him total authority over the capital flow. He can change the beneficiary at any time.
Oh, I see.
Yeah, if circumstances change and he decides the payout should go to a different family member or maybe a trust, he executes that change unilaterally.
Without asking anyone else.
Exactly. And if he decides that premiums are no longer worth the investment, he cancels the policy. The architecture is designed this way to separate the management of the risk from the target of the risk.
And that separation of risk management from risk exposure dictates how an insurance company actually operates day to day.
It really is the engine room of the whole industry.
The source material outlines 5 main pillars of the insurance industry: underwriting, pricing, claims, regulation, and risk management, and every single one of them relies on knowing exactly who holds the contract.
Let's examine the mechanics of those 5 pillars, starting with underwriting.
Okay.
When an insurance company evaluates risk during the application process, the legal burden of truth falls entirely on the policyholder.
Meaning what exactly?
Meaning, if a corporation applies for a commercial liability policy and misrepresents the hazardous nature of their manufacturing facilities, the insurer will eventually sue the corporate policyholder for misrepresentation.
Ah, they don't sue the individual floor managers who are actually doing the hazardous work.
Exactly. The contract creates a legal fence around the policyholder, making them the sole point of accountability.
That makes total sense. And the pricing pillar operates on a similar split dynamic.
It does.
The carrier calculates the required premium based on the actual risk associated with the insured exposure. So if we look at auto insurance, the pricing algorithm analyzes the driving record of the covered driver.
Right, but the billing department doesn't send the invoice to the covered driver.
Nope, they send it to the policyholder. And the carrier doesn't concern itself with how the policyholder sources the funds. It's exclusively the policyholder's job to pay them.
Yeah, the risk pooling mechanism relies on the policyholder acting as the financial conduit.
Okay, here's where it gets really interesting. The claims pillar.
Oh yeah. This is where the separation becomes highly technical.
Because when a loss occurs, the policyholder carries the contractual duty to notify the carrier and initiate the process. They manage the administrative burden of the claim.
Right. However, the disbursement of the claim payment is dictated by the principle of indemnification.
Which means restoring the financial state that existed prior to the loss.
Exactly.
But the text notes that the claim payment frequently bypasses the policyholder's bank account entirely and goes directly to a third party, like a repair shop or a medical provider or a beneficiary.
Yes, it does.
But if the policyholder is the contract owner, shouldn't they receive the funds to distribute as they see fit?
You'd think so, but if the carrier simply handed the cash to the policyholder, they would jeopardize that principle of indemnification.
How so?
Let's say a commercial warehouse suffers massive fire damage.
Hmm.
The carrier's contractual obligation is to repair the physical risk. If they just cut a massive check to the corporate policyholder.
The corporation might just divert those funds.
Exactly. They might use it to pay off debt or issue dividends, leaving the warehouse in ruins and the asset degraded.
Wow. Okay.
So by legally separating the entity that manages the claim from the entity that receives the funds, the carrier ensures the capital is deployed specifically to repair the risk.
That is so smart. And that leads directly into the fourth pillar, which is regulation.
Right, the legal framework.
The heavily regulated nature of the insurance industry, overseen by state bodies and organizations like the NAIC, the National Association of Insurance Commissioners, is structured to treat the policyholder fairly.
Yes, the laws are designed specifically around them.
The regulations require carriers to provide specific legal disclosures, cancellation notices, plain language summaries, strictly to the policyholder. The state protects the contract owner because they are the legally bound party.
And the final pillar, risk management, is where this concept reaches its maximum scale. We are looking at massive corporations purchasing incredibly complex commercial insurance to transfer existential business risks like cyber liability or supply chain disruption off their own balance sheets and onto the carriers.
And the corporate entity maneuvering those financial pieces, leveraging the insurance market to stabilize their stock price and protect their operations, is acting purely in its capacity as a commercial policyholder.
Exactly. So if you don't grasp the mechanics of those 5 pillars, underwriting, pricing, claims, regulation, and risk management, you literally cannot understand how the insurance mechanism functions.
You don't know who holds the liability, who is billed, or who the state protects.
Right. And because this legal structure is so precise, so rigid, exam writers use it to engineer the most difficult questions on the CPCU exams.
Ah, the exam traps. We need to talk about surviving the CPCU exam.
Yes, this concept is foundational across the curriculum.
Like where specifically?
Well, CPCU 530, which focuses on business law for insurance professionals, will heavily test your understanding of a privity of contract. CPCU 540, finance and accounting, will test how premium liabilities hit the balance sheet of the policyholder.
Got it.
And CPCU 551 and 552, covering commercial property and commercial liability, require you to untangle these complex scenarios where, say, a parent company is the policyholder, a subsidiary is the named insured, and a third-party vendor is an additional insured.
That sounds like a nightmare.
In every single scenario, the test will try to blur the lines between these roles.
The study companion outlines the classic exam traps designed to exploit human intuition. And the primary trap is assuming the policyholder is always the insured.
Yeah, they'll present a scenario where an individual suffers a severe covered loss and then ask who has the authority to negotiate the settlement or cancel the policy.
And your brain naturally wants to assign power to the person who suffered the physical or financial pain.
Exactly. But the exam requires you to isolate the policyholder.
And the second major trap is assuming the policyholder automatically receives the claim payment.
Right. A scenario might detail a policyholder reporting a loss, but the correct multiple-choice answer will route the payment to a designated loss payee or repair facility based on indemnification.
So the test measures your ability to enforce legal precision over emotional logic.
That's a perfect way to put it. To successfully navigate these questions, you have to adopt a specific analytical framework before you even glance at the multiple-choice options.
The source material refers to this as the 3 questions framework, which is brilliant for beating these traps.
It really is. It's about tracing the flow of legal liability and capital.
So when you read a scenario on the exam, you need to extract 3 distinct pieces of data. Question 1, who owns the policy?
Right. That identifies the policyholder, the entity holding the unilateral power to change or cancel the agreement.
Question 2, who is insured?
That identifies the insured, the actual exposure the carrier is pricing the risk against.
And question 3, who receives the benefits?
That identifies the beneficiary or the loss payee, the final destination of the indemnification funds.
Pinpointing those 3 elements clarifies the entire legal structure.
It does. But if we connect this to the bigger picture, we also need to factor in the timeline of the contract to avoid terminology traps.
What do you mean by timeline traps?
Well, before a policy goes into effect, the entity filling out the forms and requesting coverage is strictly defined as the applicant.
Okay.
Once the carrier issues the policy, that applicant transitions into the role of the policyholder. And the declarations page of that newly issued policy will specify the named insured.
Which, as we've said, can be tricky. While the policyholder and the named insured are frequently the same entity in personal lines, like a homeowner's policy, commercial lines frequently separate them.
Exactly. Then you have the broader category of simply the insured, which encompasses anyone protected by the policy terms.
Like an employee driving a company vehicle.
Yeah.
They aren't named on the declarations page. They don't own the contract, but they receive the liability protection while operating the vehicle.
Right. Tracing these roles requires you to view the insurance contract as a distinct legal ecosystem. The policyholder is the sovereign of that ecosystem.
A sovereign, I like that.
They're responsible for its upkeep and holding the sole authority to interact with the carrier. The insured is the asset residing within the ecosystem, shielded from the elements, but lacking authority.
And the beneficiary is the entity designated to extract the value from the ecosystem if a triggering event occurs.
Precisely.
So, distilling this down to its core takeaways for you listening, the policyholder executes the agreement and assumes the financial liability of the premiums. The insured represents the risk exposure, and the beneficiary receives the financial payout.
That's the golden rule.
Keeping these strictly separated is not just a semantic exercise. It is the fundamental mechanism that makes risk transfer possible. And honestly, it is the only way to systematically dismantle the traps you will face on the CPCU exams.
The precision of this system is what allows the global economy to manage risk.
Yeah.
However, it leaves us with a highly complex legal tension that is worth analyzing. Okay, let's hear it.
We establish that regulatory bodies like the NAIC design their model laws specifically to protect the policyholder, because the policyholder is the contract owner.
Right. The regulations ensure the carrier doesn't exploit the contract owner.
But consider a complex scenario where the legal interests of the policyholder directly conflict with the physical or financial needs of the insured or the beneficiary.
Oh, man.
Yeah. If a corporate policyholder decides to aggressively cut costs and unilaterally reduces the limits on a commercial liability policy without informing the employees who operate in a hazardous environment, the policyholder is acting completely within their contractual rights.
Wow. And the carrier has to comply with the policyholder's request, even if it leaves the insured employees dangerously underprotected.
Exactly. If the law's primary duty is to ensure the agreement between the carrier and the policyholder is executed fairly, who protects the actual people experiencing the loss?
That is a dark thought. The system inherently prioritizes the contract owner over the vulnerable people. The regulatory framework protects the flow of capital, but it relies on the policyholder to act in the best interest of the insured.
And when that alignment fractures, the legal doctrine of privity prevents the insured from intervening at all.
It's a profound structural reality of contract law, a tension between administrative authority and human vulnerability. It's a fascinating legal gray area to mull over during your next study session.
It really is. So next time you look at the fine print of a commercial policy or a monthly bill, you are looking at exactly who holds the authority and who is merely permitted to consume the benefits.
It really changes how you view every contract you encounter.
It sure does. Keep studying, keep questioning the mechanics behind the fine print, and we'll see you on the next deep dive.